Welcome to my channel. That was so ugly already. Alright, what is up guys? This is my first video ever. So if you're on here, you're an OG, bro. My name is Alessio. And in this video, we're gonna be talking about why you buddy, need to invest right now. Especially if you are young, but this could really go for anyone at any age, unless you're 2 or 3 or something like that. All right, now let's dive in. The two biggest takeaways I want you to take from this video is what is investing and why should I invest? It's because it's always important to start off with the why. In order to do that, you need to know what it is. We're going to start off by explaining what is investing. According to Investopedia, the definition of investing is, throw up on the board. Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. You can invest in endeavors such as using money to start a business, or in assets such as purchasing a house to resell later at a higher price. Pretty much investing is using your resources, which could be, your money, or it could be your time, like you watching this video and investing your time into it, hoping that you'll get something out better in the future, which you will. The word assets is in this definition. If you don't know what that means, it means a resource with economical value that you have and that you're expecting to provide a future benefit. So it's pretty much just something that you're holding on to that has value. For example, if you have $2 and you're gonna buy some Pokemon cards, some rare ones, to resell, maybe like a year later, that's like investing. So there's something called the risk-reward trade-off. And this is important to know when you're learning what is investing. Remember, I said you have an expectation of a return on something you're investing in. That expectation is correlated with the risk of that asset. I'm gonna throw up the definition up here. Low risk investments mean lower expected returns, while higher returns are usually accompanied by higher risk. I'm gonna throw up this chart up here. And here is basically gonna be a risk and return graph. And we're gonna be going through this and explaining very briefly what these are. We're gonna start off with the basic cash system. So if you have $5, this is considered just cash. It's considered low risk because it's currently being used. People are, especially if you're in the United States, you can buy stuff with $1, there's demand for it. People accept dollar bills. However, there is a risk with the US dollar. It could be printed, and basically what that means is you can print more of it and then it's not so rare, but it's considered the lowest risk. However, you're not going to really grow your wealth with keeping all your money in cash. Next thing we got up on the scale is certificate of deposits, shortened for CD. And what these basically are financial products. For example, Bank of America, either on their website or in person, they'll have these little packages that you could buy. You would put in, for example, $1,000. You would buy the $1,000 package. You give them $1,000 and it has a fixed term period. For example, 1 year. Let's say it's like a 1-year CD for $1,000. They hold that $1,000 for 1 year and you cannot take it out. What do you get out of that? They will give you a fixed interest rate, for example, at 0.03%. At the end of the year, you will receive your $1,000 with an additional 0.03%, which is equivalent to 30 cents of 1,000, which is extremely garbage. I mean, who wants 30 cents? Certificate of deposits are probably one of the worst investments you can do in 2021. I do not recommend it. It's mostly if you really don't trust stocks or anything like that, you're extremely conservative, you really won't want to lose anything, then it's okay. Like I said, low risk equals low rewards. Next up on the scale is the money markets. It's very similar to CDs, except that instead of just you loaning the money to the bank, they're using that money to invest into other securities. Securities is just a fancy word for stocks, index funds, and ETFs, which sound weird right now, but I will explain those later in the video. Next up is bonds. How bonds work are similar to the CD, that sort of format where you're loaning money, but except it's to governments. It could be federal level, like the US government. It could be state level, like Texas or Florida government, and local. Also, there's corporate bonds as well, like companies like Apple that you can loan your money to, and then they'll pay you back with interest. They have okay returns. They're very low risk though. Like, you most likely will be paid back by the governments or big companies. However, there's no guarantee. There is a chance that they won't pay you back. The old time gold. Hey, I don't trust anything but gold. I need stuff but gold, you know.
Gold protects my purchasing power against runaway inflation, and it's the only currency I trust.
You know, we got some of those guys. Gold's been around for the beginning of time, and it's still continued to prove its perseverance. Gold is interesting because it's not like everyone wants to buy gold, especially if, you know, the economy is doing good in your country, then you don't really need gold. But the time that gold comes into play is when, if you guys heard of the Great Depression, where basically everyone was out of jobs, all the companies were losing revenue, they were making losses, and the gold was going up in value. I'm going to make videos very in-depth in each of these categories so that you guys can fully understand what they are and how to invest and even trade in some of them if you want to go that route. Don't recommend it for beginners. Next up we got is real estate, which is pretty much homes or land. This is a very good one because there's only a limited amount of land on the earth. This goes for gold as well. There's only a limited amount of gold that can be produced at once, which is what makes it valuable. Obviously, there is risks with real estate as well. If you buy a house and it gets burned from like some weirdos.
Oh, wait! Oh, here we go!
And you don't have insurance on it. Our next one, we got stocks. Stocks is a very big category. There's so much in stocks. To name a few: Apple, Google, Tesla, Mickey D's, you already know. And this is a new one, and that's cryptocurrencies. I'm a pretty big fan of cryptocurrencies. They are very debatable, and I will say that they are probably the most risky investments you can do, but the most rewarding. I mean, I'm talking insane rewards, but insane risk. All right, so if you made it this far in the video, bravo. You get a chocolate chip double whammy. We're getting closer to the good stuff. I'm gonna explain to you guys how some of the stocks work, because that's one of the easiest and biggest categories out there. For example, Apple, the company, you know, Apple. There's something called a share or a stock. They're the same meaning, they just have different names, and it means this: a piece of ownership in a company. Now, not all companies out there are publicly traded. Not every business you see out there you can actually buy a piece of. Only the ones that are on the exchanges. So the way you would buy, for example, like Apple, you would go through the brokerage firm. A brokerage firm is a financial institution that helps you buy and sell stocks and other securities. Now, for example, Robinhood is an online trading brokerage, and I'm gonna be explaining to you guys how to use this. It's one of the best beginner apps that you can use to get started with investing. I'm gonna show this in my how-to video. Let's say you buy one share, like one stock of Apple, and the price is $1, just to make things simple. The company releases the new iPhone 20. Oh, we got 20 cameras now. Look at these guys, look. And Apple makes $1 billion in sales in whatever, 2030, whenever that comes up. Since they made money with those sales, now the value of the company is worth more money because they have an extra $1 billion in their bank account. Your one share that you bought for $1 can now be $5 10 years later when that new phone comes out. And then you can sell that and then make a $4 profito, you know? That's not Spanish, by the way. Now we're gonna get into the meat and potatoes, man, you don't know, of why you need to invest now, no matter what your age is. And even if you're, I'm gonna say this, even if you're under 18, I'm gonna show you guys how in an upcoming video. Numero uno. The first one we have is the power of compounding interest. Compound interest is interest you earn on interest. Well, we're gonna break this down with the S&P 500, which stands for Standard & Poor's 500. We're gonna actually go to the computer for this. All right, so now we're on my computer and I just searched up S&P 500. So here you can see the price history. And so now I'm gonna show you guys some facts about what this is. So the S&P 500 index originally began in 1926. And pretty much what it is, a collection of the top 500 companies in the United States. When you buy the S&P 500, you're buying 500 companies all combined into one stock. As you can see, the price here is $3,855 as of January 25th. That's kind of a lot, but in my how-to video, I'm going to show you guys how you can get this index fund for just $1. Yeah, it's gonna be crazy. According to Investopedia, since its inception, since 1926, all the way through 2018, it has approximately 10 to 11% average annual return. So what that means is it has that 10% interest rate. So if you put $100 last year into this index fund, today it would be worth $110. So, you know, $10 is not much, but now I'm gonna show you guys the power of compounding interest, the most craziest thing when it comes to investing. So just search up compound interest calculator into Google. I usually just click the first one, which is usually in investor.gov. How this basically works here: initial investment, which is how much you're putting down. So for this example, we're gonna say we're putting down $1 contribution. That just means how much you're gonna put each month. Like if you were to put like $1 a month, but we're not gonna do that for this part. 10 years. So let's just say we hold it for 10 years. In 2030, we cash out. You know, the interest rate is about 10% for the S&P 500. Compound frequency is gonna be annually. It's annual. So our $1 turns into $2.59. Not much, right? Like I might as well just keep my dollar and right now. We're gonna now this is where things get crazy. Let's say you got a job at Chipotle or maybe Mickey D's, and let's say you're putting $300 a month into the S&P 500 for the next 40 years. Actually, no, yeah, 40 years. Actually, yeah, let's do next 50 years. If you're watching this and you're like 20, you'll be like 70. And if you're watching this, if you're like 15, you'll be like 65, which is like retirement age. Interest rate 10% and compound annually. Calculate. Well, bam, boom, 4 mil, bro. What the heck? Gonna be a 4 mil from $300 a month? Oh yeah. I mean, look at this. Just look at this. This is the power of compound interest. I mean, look at that. Like year 20, it's like it compounds. It's like it grows 10% on 10% on 10% on 10%, and it keeps going up, and it's crazy. I mean, let's say, well, you see like by 10 years in, you start seeing it's like doing really good. You do $400 a month, bam, 5 mil. But let's just say you're like, I'll just wait till I'm 30, so I don't have to worry about that now. You wait till you're 30, so you're down 30 years left. Oh my G, you're only gonna get 600K, which, you can't complain about that, but why not try to go for the 4 mil, One thing I want to additionally add on to about the S&P 500 is the process of diversification. Diversification is very important when it comes to investing. Remember how the S&P 500 is a combination of 500 companies. It lowers your risks of potentially losing all your money, because 500 companies, that's including, Apple, Amazon, from different industries like the medical, construction, oil, banking, all of them combined. And the chances of the top 500 companies in the United States disappearing is almost like zero. It would basically mean the entire US is kind of done. Let's say Apple's in that portfolio of, you know, the 500 companies. Let's say it goes down from $1 to 50 cents, like a 50% drop. It goes from $1 to 50 cents. But other 499 companies are going up 10%. Well, then if you do the math, it's still going to be up. Not 10%, but it'll be maybe like 9 point something percent. But you get the point. You don't want to put all your eggs in one basket. Spread your money across, you know, the assets you believe are best for you. There is such thing as over diversification, where you put your money in way too many different assets and your money's all over the place, and you won't be able to take advantage of the ones that are making big profits, because not everywhere is going to be making big gains. So it's important to not overdo it. Number 2, beating inflation. Inflation means the price of goods and services rise and go up and cost more money. So your dollar buys less as inflation goes up. According to Investopedia and on the government website, IRS, where the US average inflation rate annually is about 3%. It's not always 3%, but on average, it's about 3%. If you saved $100 in 2020 and you put it, you know, in your pencil box, I know you guys do that, the fake keys, and now in 2021, it's $97. Physically, it's still a $100 bill. But now, the new consoles are no longer $200 to $300 now. Now the new consoles are $400 to $500. You see what I'm saying? That's inflation. The prices will continue to keep going up. Put $20 into the S&P 500 and your other $80 in the pencil box. Your $20 went up 10%, so now you're at $22, and then you still have your $80. So now you have $102. But inflation takes away that $3, but now you're just at 99. And obviously, if you put more money and you wait longer, it'll be obviously more money. That's very important because inflation is real and it happens every day and it will continue to happen. So I wouldn't want to be sitting 100% cash if I were you, because you're basically losing money. Number 3, easy access. I mean, it's never been easier before than today to invest into your favorite companies or the S&P 500 into Bitcoin. Buying a piece of a house for just as little as $1. You can buy pretty much anything for as little as $1. You can buy a piece of Apple for $1, a piece of Amazon for $1, a piece of Bitcoin, and right now it's like at 30K as of recording this video. You can buy $1 of it and still take advantage of its insane returns. Number 4, passive income, baby. You already know, bro. I mean, like, you can just play like Call of Duty, Among Us, whatever you play, or even just doing school on the side and know that, and you just flip on your phone and you see, like, you know, you're making money. Time is like, it's like, all right, that's kind of nice to know. Number 5, securing the retirement bag. Think about when you reach 65 years old and you retire. Your back hurts, you've been working at Mickey D's for 60 years, and now you want to be able to buy Chipotle still 3 times a day for however long you live, which could be, you know, a long time, 30 years if you're lucky. I mean, honestly, I would work, but I don't know, like, about you. And so it's good to have, you know, some acorns saved up for the future to help out, like, your family and maybe some friends that you could just help out in the future. Now, if you're really like, no, I didn't even do invest early, no, I have no money for my future. Well, just know it's never too late. Life isn't totally dependent on how much money you make, guys. It's honestly, you could be chill even at 65 without money. Always put your hope in God. Never put your full on hope into investments and money, guys. Always keep God first. And then, you know, if you're blessed with some extra money to invest, you can do it if you want to. Whoa, first vid, okay. Wow, that must be intense for you guys. I don't know, I think the last time I checked, it was like 20 minutes on this. If you guys did watch this, congratulations. You now know a lot more than probably 50% of the United States. And I will be coming up with a how-to video soon. Thank you guys so much for watching, especially if you made it this far. I really appreciate that, and I'm really just glad you got some extra knowledge. And stay chill, homies.